Can you believe that Nestle stock is down 40% from its highs? It didn't lose so much even during the great financial crisis, where from peak to low it was down around 35%. So maybe there is finally a good buying opportunity in one of the safest bets in the world probably. This is probably one of the most dominant and safest companies in the world. Welcome back to a new video. I am the Italian investor and today we talk about Nestle. If you like this type of videos, please subscribe to my YouTube channel and of course leave a like to this video. So the stock plunge has taken Nestle valuation to the lowest levels of the past decade. Right now the forward price earnings ratio is 16, while the last 12 months price earnings ratio is around 17. And generally this stock trades around a price earnings ratio of 20, which is fair for such a company. There is not much growth, but margins are very high. And this is probably one of the top 10 most stable companies in the world. They make 92 billion in revenues and they offer products which you buy in every type of market situation. You're gonna buy their products also during a recession. The EBIT margin is really good at around 17% and also return on capital is pretty good at 15% and return on equity is even better at 32%. So the quality of this company is sure, there are no doubts about it. The problem is that the company doesn't grow much. It's mature, it's stable, so revenues are not gonna go up a lot in the next few years. And actually they are gonna be fairly flat. And this is the reason why I'm not gonna buy Nestlé, but it could be a good stock for someone who wants a safe and stable portfolio. But for sure you're not gonna get a crazy return on this investment. Indeed, this is my valuation. I believe revenues are gonna hit 103 billion Swiss franc in 2029, and the company could probably have an EBIT margin of around 17%. So net income should reach around 12.8 billion Swiss franc, which would equal to an EPS of 5.9. In calculating the EPS, I considered buybacks and stock-based compensations, as you can see in the file. And I applied a 20 price earnings ratio, which would take the stock to 118 Swiss franc per share. And to this you can add a good dividend yield, which right now is at 4%, and you're probably gonna get something like that every year. The company has been very stable in paying dividends, also during the pandemics. So buying the stock right now, you could get something like a 10% annualized ROI plus dividends, which would take the performance at around 14% per year. This is not bad at all. It's a fair performance investing in a stock which is probably gonna be stable in the future. It already lost a lot. I don't think it's gonna lose much more. It's very unlikely in my opinion. Therefore, this is probably one of the safest bets on the market. Let me know what you think about the stock, type a comment, and of course remember to leave a like and subscribe to my YouTube channel. Thank you very much if you will, and see you next time. Bye!